Wesdome Gold Mines just heavily missed Wall Street consensus on both the top and bottom lines for their Q2 2026 earnings. So let's get straight into the numbers. Actual revenue came in at 266.76 million Canadian dollars.
Wow.
Yeah, which misses the 321.22 million consensus estimate by nearly 17%. And adjusted earnings per share, just 65 cents Canadian, completely missing the 78-cent estimate.
Right. And, looking at the guidance update, it's a bit of a mixed bag. Management did reaffirm their full year 2026 production target, so that's still 180,000 to 205,000 ounces.
Okay, that's something.
Yeah, and their cost guidance stayed flat too, right, at 1,525 to 1,700 US dollars for all-in sustaining costs. But, and this is the big one, they lowered the average grade guidance at their Eagle River mine down to 11.5 to 12.5 grams per ton.
Down from the 13 to 14 range, right?
Exactly. Plus, they raised full-year CapEx guidance by up to 10% from the original 205 million Canadian, while simultaneously cutting depreciation and depletion guidance down to 100 million.
Right, so the stock reaction was pretty immediate. I mean, pre-market, it was basically flat, maybe down just 0.12%. But once regular trading opened on the TSX, the stock just fell 3% to close at 32.68 Canadian.
And honestly, that drop happened while peer gold equities were actually surging.
Oh, really?
Yeah, on pure technical momentum. I mean, Wesdome was trading right near its 52-week high just prior to this print. So the market basically looked at those top and bottom line misses and just hit the sell button.
Just a total stock-specific punishment.
Yeah, heavily punishing the stock and completely ignoring the broader, macroeconomic gold rally we're seeing right now.
Imagine looking at an X-ray of an Olympic athlete and diagnosing them as terminally ill just because they have a bruised rib.
Right.
Because that's essentially what Wall Street just did to Wesdome here.
Yeah.
And you sent us this massive stack of Q2 earnings transcripts, independent technical reports, and raw drill data to really figure out if this company is a value trap or a hidden gem.
Because the numbers just don't tell the whole story.
Exactly. Our mission for you today is to cut through all this headline panic and look at the actual physics and the financials of what is happening underground. Because right out of the gate, we have this massive paradox.
Yeah, the revenue paradox.
Right. How does a company grow its revenue by 28% year over year, operating in a record high gold price environment where they are literally realizing over 4,300 US dollars an ounce, and still miss Wall Street expectations by a mile?
Well, to answer that, you really have to look at the operational friction at their flagship asset in Ontario.
Eagle River.
Right, Eagle River. The headline numbers there are honestly pretty jarring. In Q2, Eagle River milled 72,439 tons of ore.
Which is a massive jump.
Yeah, a massive 49% year-over-year increase in throughput. I mean, they are moving a tremendous amount of rock right now.
Right.
But the average grade of that rock just plummeted by 42%.
Dropping down to 9.7 grams per ton, right?
Yeah, from 16.9. So because the grade fell so sharply, total gold production at the mine actually dropped 15% to 21,797 ounces.
See, I have to push back on the company's narrative here because management is spinning this as a deliberate, fill-the-mill strategy.
Right, that's a corporate line.
But think about this from a basic mechanical perspective. You are putting 50% more wear and tear on your heavy equipment. You're burning significantly more diesel fuel. You're paying for way more labor to drill, blast, and haul all this extra rock.
Yeah.
And your end product, the actual gold output, drops by 15%. I mean, that sounds like absolute margin destruction. Why should you, as an investor, buy this as a value-focused strategy rather than just calling it what it looks like, which is a geological failure?
I get it. It sounds terrible on a 3-month horizon. But if you look at the mechanics of underground mining, this isn't a geological failure at all.
That's not.
No, it's a highly choreographed structural reset. You see, historically, Eagle River was operated by chasing the highest grade veins quarter to quarter, mainly just to satisfy short-term earnings.
Okay.
But when you cherry-pick a mine like that, you effectively destroy its future.
Because you're taking all the structural support out.
Exactly. When you only follow the richest, narrowest veins, you create this erratic, unstable footprint. You end up having to leave massive pillars of slightly lower grade, but still highly profitable ore behind.
Just to keep the roof from caving in on you.
Right. So over time, your mine becomes this labyrinth of stranded assets that you can never safely retrieve. What management is doing right now is integrating what they call global model ore into an updated mine plan.
Okay, but what does that mean, practically speaking, like underground?
It means they are widening their mining stopes. Instead of surgically extracting a, say, 2-meter wide vein of 20-gram rock and leaving the 5-gram rock right next to it, they are bulk mining the entire 5-meter span.
Ah, I see.
So the average grade drops, which is exactly why we saw it fall to 9.7 grams per ton. But the total volume of profitable rock extracted over the life of the mine increases dramatically.
Okay, I follow that. But how does moving more rock with less gold in it actually help the bottom line today?
It all comes down to the fixed costs of the processing mill up on the surface. A mill is a total beast.
Right.
It costs roughly the same amount of money to keep the lights on, run the crushers, spin the ball mills, and pay the operators, whether that mill is running at 50% capacity or 100% capacity.
Oh, interesting. So by aggressively increasing the tons mined by 49%?
They are forcing the mill to run at maximum efficiency. They are basically distributing those massive fixed overhead costs over a much larger tonnage base.
So they aren't out of high-grade gold. They're just like forcing the mine to eat its vegetables to build a sustainable foundation before it gets dessert.
That's the perfect way to look at it. And the operational setup for Q3 proves the dessert is still very much on the menu.
Yeah.
Yeah, the next 300 zone stope at Eagle River is fully drilled off right now. They had 25,000 tons of rock ready to mine in the coming months. And the grades sitting there are reaching up to 25 grams per ton.
Wait, 25 grams per ton? That is incredibly rich for a bulk stope.
It is. Analysts who toured the site in July actually saw this stope firsthand. So the high grade hasn't vanished at all. It's just been deliberately resequenced.
They're just absorbing the pain of a transition quarter.
Exactly, to build a predictable, multi-year operation rather than a volatile quarter-by-quarter guessing game.
But absorbing that pain means Eagle River was a massive drag on the Q2 consolidated ounces. I mean, to keep the company's total production from collapsing while Eagle River retools, they needed ounces from somewhere else.
Right.
And that brings us to Quebec, because their Kiena complex was really the engine keeping this entire ship afloat.
Yeah, Kiena delivered an exceptional quarter. Production rose 28% year over year to 22,026 ounces. Throughput increased 24%, hitting 62,515 tons milled.
And the grade actually went up there.
It did. Unlike Eagle River, the grade at Kiena ticked up 4% to 11.1 grams per ton.
The numbers are great, but the physical infrastructure they just unlocked is what really stands out in the source materials you sent over. They finally broke through that new ramp from the surface all the way to the bottom of the mine.
Yeah, and that breakthrough is arguably the most critical operational milestone of the year for Wesdome.
Really? More than the production numbers?
Absolutely. Because in underground mining, ventilation dictates absolutely everything. You can only put as many miners and as much heavy diesel equipment underground as your fresh air supply allows.
Right, otherwise the exhaust just builds up.
Exactly. If you exceed that airflow, the heat and diesel particulates literally become lethal.
It's like trying to run a marathon while breathing through a cocktail straw. Doesn't matter how strong your legs are or how fast your trucks can theoretically drive, your oxygen intake strictly dictates your speed.
Precisely. So breaking that ramp through to the surface, just replace the cocktail straw with a high-flow oxygen mask.
Nice.
This new direct access enables a massive ventilation expansion project that is literally doubling the air capacity of the mine.
So by establishing these 3 active mining horizons, and I think they have a 4th coming at level 142 in 2027, they aren't just telling the miners to work faster.
Right.
They have fundamentally expanded the physical and atmospheric capacity of the entire operation.
And we are already seeing the production traffic start to flow through it. In July, they blasted the first production stope at a brand new zone called Presqu'île.
Presqu'île, yeah.
That zone alone is expected to hit a run rate of 300 to 400 tons per day by the 4th quarter.
Wow.
Yeah, when you combine that fresh ore with the existing Kiena deep zone, you're pushing the entire Kiena complex toward a 1,000 ton per day target by 2027. They've built the ventilation highway, then they were just waiting for the trucks to hit full speed.
But building massive underground ventilation highways and moving 50% more rock at Eagle River isn't free.
No, definitely not.
In fact, the toll for all that infrastructure is exactly why their financials suddenly look like they are bleeding. Which brings us to the margin squeeze. Extracting this gold is getting significantly more expensive.
It is, and this is where the Wall Street consensus really missed the nuance. Wesdome benefited from an exceptionally high realized gold price this quarter. They reported an average realized price of 6,040 Canadian dollars per ounce.
Unbelievable.
Yeah, that's roughly 4,365 US dollars.
Which is just staggering. I mean, if you told a gold miner 5 years ago they'd be realizing over $4,300 an ounce, they would have assumed they were dreaming.
Absolutely. But despite that top-line windfall, their consolidated cash costs surged 45%.
45%.
Yeah, up to 1,342 US dollars per ounce. And their all-in sustaining cost rose 15% to 1,763 US dollars per ounce.
And obviously, that margin squeeze hits the bottom line directly. Free cash flow dropped year over year from 53 million Canadian down to 42 million.
Right.
When you have record-breaking gold prices, you expect free cash flow to explode upward, not shrink by 11 million bucks.
It's totally counterintuitive. But this is exactly why you have to look under the hood of the cash flow statement. That drop wasn't due to some structural decay in the business model.
What was it then?
A huge chunk of that was a 21 million Canadian dollar prepaid tax installment that just happened to hit in Q2.
Ah.
Plus, they had elevated growth capital spending, specifically paying premium rates to contractors to finish that critical ventilation ramp at Kiena we just talked about.
So it's largely a timing issue. The tax bill came due, and they paid the heavy upfront toll to finish the infrastructure.
Exactly. Management expects free cash flow to increase significantly in the second half of the year as those one-time capital-intensive items roll off. But they aren't just sitting back and hoping the gold price stays high to bail them out.
Great, they have a plan.
Yeah, CFO Phil Yee outlined 3 very concrete, mechanical steps they're taking to protect their margin resiliency right now.
First up, they are entirely overhauling their supply chain management. They've brought in a new corporate structure and have already identified several $1 million in savings just by optimizing how they store inventory and negotiate supplier contracts.
With millions more expected by year-end, yeah.
And second, they are actively reducing their reliance on expensive external contractors.
Which makes perfect sense when you understand the mining life cycle. When you are blasting a new ramp or expanding quickly, you bring in specialized contractors.
Because they have the gear and the speed.
Exactly. You pay them a massive premium for that speed and equipment. But once that ramp is finished and the mine enters a steady state of production, you transition those daily operational roles to your permanent workforce.
And the hourly rate plummets.
Yep. And your long-term costs stabilize. You stop renting the expertise and you bring it in-house.
Makes total sense.
And the third step is proactive maintenance. They are fundamentally changing how they treat their mills. They are moving away from a reactionary model, fixing a crusher only when it snaps in half, to a system-based predictive maintenance schedule.
Right, preventing the breakdown in the first place.
Exactly. And it is already showing up in the data. Unplanned downtime at the Eagle River Mill is actually down 60%.
Wow. And when your mill is running 60% more reliably, those massive fixed costs we talked about earlier get absorbed that much faster. Which actually brings us to a really fascinating aspect of this quarter. Capital allocation.
Yeah, the balance sheet.
Despite the earnings miss that punished the stock, Wesdome is sitting on an absolute financial fortress. They ended the quarter with 391 million Canadian dollars in cash and 0 debt. Total liquidity is sitting around 746 million.
And, when a mid-tier mining company is sitting on that much unallocated cash, it usually makes the market really nervous.
Why is that?
Because the temptation is to go buy another company. Historically, miners tend to overpay for flashy acquisitions at the absolute top of a gold cycle, destroying shareholder value in the process.
Oh, right. Digging a hole to fill a hole.
Exactly. But Wesdome is taking a very different route here.
They are acting like a mature, value-driven tech company. I mean, they just initiated a quarterly dividend of roughly 3 cents per share to return cash directly to shareholders. But the real aggressive move is the share buyback. They expanded their normal course issuer bid to 6% of the public float. They have already repurchased nearly 8 million of their own shares for about 190 million Canadian dollars.
Think about the conviction that requires. They are looking at their stock trading near a 52-week high, looking at the cash on their balance sheet, and deciding that buying their own ounces in the ground is still the highest return, lowest risk investment they could possibly make.
That kind of financial swagger doesn't come from a 2-year mine life. You don't empty your treasury to buy back stock if you don't know where your next ounce of gold is coming from.
You really don't. And that leads us to what management considers the single most important takeaway of the entire quarter.
Which isn't the revenue.
No, it's not the revenue or the EPS miss or even the gold price. It's a metric that completely shifts Wesdome's narrative from a junior company trying to survive to a mid-tier producer with district-scale stability.
And that number is 8. 8 years. For the first time in this company's history, independent technical reports have confirmed 8-year reserve-based mine plans for both Eagle River and Kiena. These plans run straight through 2033, underpinned by 1.4 million ounces of proven and probable reserves.
To understand why this is such a massive milestone, you have to look at the reality of junior and mid-tier mining. For years, Wesdome was operating hand-to-mouth.
Right.
Their mine plans only stretched out maybe 2 or 3 years. When your horizon is that short, you can't plan long-term infrastructure.
You certainly aren't going to sink tens of millions into a ventilation ramp if you aren't sure you'll be mining in 36 months.
Exactly.
Yeah.
Furthermore, a 2-year mine life makes you basically uninvestable for major institutional funds. 8 years changes the conversation entirely. It provides a foundational floor of operational stability.
But management made it very clear on the earnings call. 8 years is the floor, not the ceiling. The current 8-year plan doesn't even include potential resource conversions or new exploration. And this is where the story pivots from traditional muddy boots mining to cutting-edge technology. They are deploying artificial intelligence to drive their massive 270,000-meter exploration program.
Yeah, AI in mining.
Wait, I have to stop here because this is where I get extremely skeptical. Usually when we talk about AI, it's a language model analyzing text or like writing code. How exactly does an algorithm look at physical rocks and underground drill core data without hallucinating a gold mine that isn't actually there?
It's a great question, and it's exactly why they aren't treating this like some magic black box. They're using a specialized process called geoanalytical targeting.
Geoanalytical targeting, okay.
Right. They hired specialized consultants to digitize and aggregate decades of incredibly dense multi-level data sets. We were talking about 50 years of historical drilling logs, magnetic signatures from geophysical surveys, trace element data from geochemical soil sampling, all of it.
So they are feeding the AI the actual physical properties of the Earth, not just text descriptions.
Exactly. The AI models these variables simultaneously, which is something a human brain simply cannot do across millions of data points. And it searches for the precise overlapping signatures that have historically correlated with gold mineralization at these specific sites.
It's looking for the fingerprint.
Yeah. It generates a prospectivity ranking, flagging new areas that score above the 90th percentile.
Okay, but how do you prevent the hallucination? How do you know it's not just guessing?
Through a strict human-in-the-loop feedback system, the AI spits out a coordinate. Human geologists then review that target against their own on-the-ground structural knowledge.
Okay.
They ground truth it, refine the parameters, and then run the model again. Through this iterative process, the AI has already flagged 5 brand new high-priority zones at Eagle River that have seen minimal surface work.
Wow.
It is massively increasing their capital efficiency. Instead of blindly drilling grids and hitting dry rock, they were drilling highly targeted anomalies and finding ounces way faster and cheaper.
And we are already seeing the physical proof of this aggressive, modernized exploration strategy over at Canada, too, specifically with the new Norbenite footwall discovery.
Right. Oh, the Norbenite footwall is a perfect example of looking where conventional wisdom said there was absolutely nothing.
Really?
Yeah. Historically, the rock beyond the Norbenite fault was interpreted by geologists as a barren footwall, just a total dead zone. But they drilled from a newly established exploration drift and hit something exceptional.
The numbers on hole 52W1 are crazy.
Yeah, it returned 8.3 grams per ton over 29.5 meters.
29.5 meters. I mean, that is incredibly wide for an underground gold intercept.
It is massive. But what's equally important to the grade and width is the actual host rock itself. This mineralization is hosted in basalt, which fundamentally changes the mining economics compared to the schist that typically hosts the deeper Chiena zones.
Wait, why does the rock type matter so much to the bottom line?
Because schist is flaky, heavily foliated, and
Yeah.
physically unstable. When you mine in schist, you have to spend a fortune on ground support. You're installing dense patterns of steel bolts and thick wire mesh just to keep the walls from collapsing in on your miners.
Which obviously slows you down and drives up your cost per ton.
Exactly. Basalt, on the other hand, is a hard, highly competent volcanic rock. It basically holds its own weight.
So mining in basalt means you can blast much larger stopes, extract the rock faster, and spend significantly less money on all that steel mesh and labor to hold the ceiling up.
Exactly. Faster, cheaper, bulk tonnage mining. And furthermore, this intercept in the basalt correlates with another drill hole 150 meters below it.
So they haven't just found an isolated pocket of gold. They've proven an entirely new 150-meter vertical mineralized corridor,
Right.
and this sits completely outside that new 8-year mine plan we just talked about.
It's totally open in all directions. If they can continue to delineate this corridor, it has the potential to be truly transformational for Keena's long-term resource profile.
That's huge.
It proves that within these established mining camps, there is still massive scale waiting to be unlocked if you have the cash, the infrastructure, and the technological edge to actually look for it.
We've spent this entire deep dive looking at how Wesdome is systematically upgrading its physical infrastructure underground and its digital infrastructure through AI. But based on all the sources you provided, here's a provocative thought we really haven't touched on yet.
Let's hear it.
If a mid-tier miner with zero debt can successfully use AI to identify brand new zones, decipher complex geology like the Norbenite footwall, and effectively eliminate the massive financial risk usually associated with exploration, how long until the broader market wakes up?
That's the million-dollar question.
Right. More importantly, how long until massive tech companies or sovereign wealth funds simply bypass the public equity markets entirely? I mean, if AI can predictably prove out decades of reserves in stable jurisdictions like Ontario and Quebec, we could see these data-rich, AI-ready mining camps swallowed whole by private capital looking to secure their own physical supply chains.
Leaving retail investors completely on the sidelines.
Exactly.
When you remove the exploration risk, the valuation models completely rewrite themselves.
So when Wall Street looks at a 17% revenue miss and hits the panic button, they're reacting to the bruised rib on the X-ray. But underneath, you find a company that is deliberately resequencing its mines for longevity, doubling its oxygen capacity, and using AI to literally rewrite its own geological future, all while aggressively paying cash out to its shareholders.
The real diagnosis always takes a little digging.
It really does. You sent us the sources, and we hope this custom analysis gave you the clarity you need. Make sure you follow the show for your daily earnings coverage, where we do custom deep dives just like this one. Catch you on the next deep dive.